All right, guys, welcome back for another video. In today's video, I want to talk about Bollinger Bands, invented by Mr. John Bollinger himself. Now, I'm looking at the Bitcoin chart on the macro, but before I get into the weeds with how this indicator works, I just want to frame it in the context of what it represents. In order to do that, we need to look at the standard deviation curve right here, and so right here you have your typical standard deviation bell curve, and you've got your 34.1%, 34.1%. You may have heard the phrase that 70% of the time price trades within a range, and that's relatively true, especially with an asset like Bitcoin. If you chart the parabolic advances or parabolic declines of Bitcoin, they usually happen during a relatively small and surprisingly small period of days, and most of the time on the chart is actually spent within a range. And that fits in with the standard deviation bell curve. Um, so if you add these two standard deviations up, that's your range. That's sort of falls in line with the phrase, 70% of the time price stays within the range, more or less. Now, how does that tie into Bollinger Bands? Well, the Bollinger Bands are actually based off standard deviation. So essentially what this outer edge of the Bollinger Band represents is the standard deviation. And so what it's telling you is that, price is generally likely to stay within them. Of course, it can break, but the odds, right? We're talking about probability, and the odds of price remaining within that standard deviation are higher than it breaking. And generally, you only see them break during parabolic advances. So right here, and you might be able to describe that standard deviation edge as the boundary of the range. So you can see sometimes price will come up there, test, come down to the median, bounce off there, come down. And actually, we're coming down there on the monthly chart right here, bouncing off that standard deviation, or at least finding a footing there. And of course, it does break, but only during the parabolic advances. So you have your parabolic bull market here, price cools off. When the parabolic bull market begins again, price breaks, and then after that, it generally remains within the standard deviation model. Now, if we go to the weekly chart, you see the same type of deal. So right here, again, during your parabolic advance, obviously it breaks out of that range that was holding it hostage right there, breaks it, starts running, comes down, breaks the median right here, and then runs down for the lower band right there. Bounces exactly off it, comes up, comes down, bounces again, finds its footing, and then runs up, violates the median band, comes up, retraces down into it, and then we do get a break here, but then it closes. We don't get a sustained open and close above this level, closes back in here, and then runs down, breaks the median, runs back down for the lower side of the range, comes up, hits the median. And here you could describe this as being parabolic, right? So sometimes it will trade outside of the range, but it's relatively rare in the grand scheme of things. Of course, your parabolic advance, it'll trade above quite often, and when you have a very aggressive decline, it'll trade below. But the majority of the time is spent within these. Um, so you can think of these as, or at least I think of them as profit-taking areas in a downtrend, right? If price is declining, this is generally a good area to take profit, and then this area here, the median, is generally a good area to add risk that is taken off here. So say you had a short position from up here, you take profit down here, and then add risk up here, ride it down, take profit again here. Of course, you don't get a chance to re-add it, but again, this is a little bit of an outlier in what happened, just based off the liquidations and the blow-ups in the crypto space. But you can see here, say if you were short here, again, take profit here. Maybe you were looking at this as a sustained downtrend, and I think a lot of people were. But if the median band gets broken and price comes up, bounces off it, well then that's a good time to abandon the short bias. And if you were short from up here, you're still in profit, can close the position. Again, it's a nuanced way to look at it. There's different ways to trade this, but generally, the way I look at it is that you know these outer standard deviations represent the edge of the range, and they're generally going to be good profit taking areas. Now, with that said, when especially when you go down to the lower time frames like the daily, you can see it very clearly here in this chart. When volatility contracts like this, it's showing that volatility is coiling up, and you're getting prices moving into this low liquidity state, and prices getting ready to run. So this may be a little bit of a fake out. It looks like it closes above, but you know not really, and not on very significant volume. But then volume starts coming in here, and you get this as the Bollinger Bands are tightening up, showing you that a move is imminent. Right, and this is tying back into some of the volatility concepts we discussed before, where price is constantly moving, volatility is constantly contracting and expanding. It's just different degrees of expansion and contraction. So whenever price moves in a volatile fashion, a lot of times it'll find its footing and then enter a low volatility state, and then that's generally the area where you want to actually expect an expansion. The more contraction you see, and generally the longer um, that price spends within that contraction or consolidation period of low volatility, the further liquidity draws away from the market, and the more aggressive the expansion will be once the consolidation does in fact actually break. So you can just see that price is moving from uh, you know volatility expansion to consolidation to volatility expansion. And again, these areas are generally offering at take profit levels, right? I mean, again, it's not perfect, but if you, in general, if you use these areas to take profits, um, generally price will give you an opportunity to either add to an existing position or exit a position in a more favorable price. Um, yeah, so I think that's a general idea. Again, there's a lot of nuanced ways to use this indicator, and I don't really want to, apply a cookie cutter approach to any one trading methodology, but I just wanted to cover a broad overview of Bollinger Bands. So I hope you guys like this content. Again, just make sure to like the video, subscribe to the channel if you enjoy this content, and I'll catch you guys in the next video.